Stock markets are back on offense. Interest rates are coming in. The US dollar is weaker. Are we in the clear? That's the question that we're asking ourselves here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. Back on this shortened week, looking at what the markets are going to do without big splash US economic data and what their default path will be. There is, of course, still quite a bit of macro event risk to contend with, even with the U.S. data flow on hiatus. So we're going to unpack all of that here, see what trades might be emerging out of the mess that is the price action that we've seen through all of these closures, through all of these low liquidity periods, and of course, through all of the event risk that we've seen recently that the markets have room finally to digest in earnest this week. So let's begin here with a look at how these markets performed last week. And of course, familiar give and take stands out. Notice the S&P 500 and the NASDAQ here putting in impressive gains. Interestingly, the NASDAQ actually lagging a little bit relative to the broader index, which is a bit unusual. Typically, it has been the NASDAQ that has led the way. That is not what we're seeing here by a small margin, but nevertheless, near 3% gains for both of these major indexes, and not surprisingly, that coming alongside a pullback in yields. Interest rates down across the curve, both the 10 and the 2-year lower. The curve somewhat flatter here as a result, because rates hold up a little bit better at the front end versus the long end. The weakness here in the 10-year a little bit more pronounced at 2.9%. Against the same backdrop, dollar a little bit lower. You can see here 0.2% off versus the euro, 0.8% off versus the yen. Gold's a little bit higher, 0.8%. Bitcoin reveling in the apparent risk-on mood with a almost 11% gain. Crude oil, as ever, marching to the beat of its own drum. But the general consensus here, looking across price action, looks very much like the inverse of the preceding week, where we had strong sell-offs in the equity benchmarks. We can see here over 2% loss in both the S&P and NASDAQ against the backdrop of steep gains in yields. So this sort of give and take that we've been watching between the situation in interest rates and stocks, it continues. And of course, last week we had an inflation report out of the US that helped to make for this exact set of circumstances. The U.S. CPI report came out. Core inflation was expected to hold unchanged at 3.3%. It surprised lower, not by much, but nevertheless, 3.2% year on year. So the lowest in 4 months, unexpectedly. And that, of course, encouraged the kind of thinking that we see here. Of course, Fed policy expectations were starting to get very, very hawkish ahead of that release. And what we have here clearly points to a degree of relief that was had. And of course, now we have a lull not only in Fed speaking. They have a monetary policy meeting that's coming up, so they are staying mum this week, but a lull in big splash U.S. economic data too, at least until Friday, which we'll get to here in just a moment. But what this has done is it's given the markets some space to digest and consider and to find a kind of default. And what we're seeing here in the first day of the week is very much continuation of what we saw last week. Again, a little bit more strength from currencies against the US dollar, a little bit more strength in bonds and a deeper pullback in yields, and an encouraging pop in stock markets. So it looks like the start of this week has been essentially just continuation of the last, but there is quite a bit of event risk on this calendar that maybe isn't in the US, but that is very much pertinent to the dynamics we're discussing, and that will, of course, filter into the conversation. And we start with the situation in Europe. Now, here we have a speech from ECB President Christine Lagarde. She's due to speak at the annual gathering of the World Economic Forum in Davos, Switzerland. And she's going to be participating in a panel called Beyond the Crisis, Unlocking Europe's Potential. Needless to say, this is going to be a conversation having to do with the steady fizzling of the regional economy, which if we look at the PMI numbers expected later in the week, which we'll get to momentarily, we're eyeing a third consecutive month of contraction and significant underperformance relative to other major economies. At the same time, there is, of course, stickier inflation than the ECB would like, even as it continues to come in their direction. And so there's, needless to say, quite a lot on this panel from the ECB president that might be fodder for near-term guidance. Of course, the euro has already made a jump in a response, and what we see here is a situation that sets the table for what that kind of commentary would do, or at least against what benchmark it would appear. And we see the markets are pricing in 100 basis points in rate cuts from the ECB this year, no change next year, just 6 basis points on the menu. So what we're looking at here is already quite dovish in relative terms. If we consider how these rate cuts lay out, we can see the markets aren't expecting anything for this month. The ECB meets on the very last days of January. But come March, the markets are baking in a full 50 basis point adjustment. So of the 4 rate cuts, the 100 basis points that are on the menu for this year, we can see a big half is expected to happen in one shot. We then see a third cut somewhere around mid-year and down to the fourth one by the end. So the path is already quite dovish, and moreover, it hasn't changed very much since the middle of October. We can see these policy curves here implied in ESTR contracts. They're very clustered together. So even as there have been significant changes in the overall structure for interest rates, because of course there have been significant changes in the market's expectations of the Fed from about mid-September through early October, we might have, of course into November, major hawkish rethink for global rates as a function of what a rethink of the Fed rate structure looked like. We saw that we were looking for the Fed to deliver many more rate cuts before they actually embarked on the easing cycle in September. And when they promised 100 basis points last year and 100 basis points this year, the markets looked at a U.S. economy that looked like it was warming, looked at an incoming Trump administration that was likely to be more so supportive of price growth than less so, at least in the outlines of its policy directions, be they lower taxes or deregulation or tariffs. The story was, well, you're not going to be able to do as many cuts. At this point, the U.S. is only expected to do maybe 2 this year. And while the Fed has called for 2, the markets haven't priced even that all the way through. So there's been a major shift in interest rates all around the world on that basis. Because, of course, the ubiquity of the U.S. dollar means that when the Fed sets its borrowing costs, it's setting the cost of credit globally. That pointedly is not meant very much for the Eurozone, where this kind of dovish policy path was already locked in and hasn't really shifted very much. So as we look at this, the overall thrust seems to be that whatever Ms. Lagarde says, however she sort of paints a dovish picture, it's unlikely that we have much more to price in. If we look at the way that Eurozone economic data has behaved relative to forecasts, it has tended toward weakness. And so on this front, we have a situation that certainly would support a more dovish message, but how much more dovish we're going to get beyond a 50 basis point cut at the March meeting seems unlikely. Perhaps we'll move it up to a cut at the last moment here, getting priced in before next week's ECB meeting. Maybe that's how this plays out, but there doesn't seem to be a lot of room here for anything that's even more dovish, and therefore it seems to give the euro a little bit more scope to continue building higher, if only because it has already discounted what dovishness there is to here, or at least most of it at this point. Next, we're going to get a set of releases from Japan. This, of course, another major sort of player here as far as the influence of U.S. interest rates. The yen and local markets very, very sensitive to U.S. borrowing costs because, of course, in so much as U.S. borrowing costs drive the global trend, and interest rates in Japan are many orders of magnitude lower than almost all major economies, there is a kind of inherent proxy here where when global interest rates go up, as led by the U.S. most usually, there is a tendency to want to borrow cheaply in yen and buy higher yielding things. And when U.S. rates go the other way, that gap starts to narrow. Global rates come in relative to low ones in Japan and encourage the repatriating of funds out of whatever bets were taken with shorted borrowed yen to cover those yen loans, because the sort of relative yield differential narrows, and so the trade becomes less appealing. With that in mind, we look this week at a Bank of Japan that is expected to raise interest rates again. Here it is on the curve. There is no meeting in February, so we can see that from January to February, the futures are pricing in this move. The current rate, of course, at a quarter basis point, and we see here this is now approaching half of a percent, and so this would imply one hike. We can see, though, over the course of these months, it takes some months to fully price this in. So this is almost something like a window in which we could see hikes. We then get another window for further adjustment up to almost 75 basis points here by year end. So a total of 50 basis points or almost there being baked in for the year, essentially one hike at some point this week or shortly thereafter at the meetings soon to follow, and then another one at the mid-year mark or shortly after. If we consider then the lead-in, before we get the Bank of Japan policy announcement, CPI data from Japan is due, and the expectations here are for faster inflation. The headline number seen rising to 3.2%. The core number, which excludes, in the case of Japan, just food, but includes energy, that's expected to go up to 2.9%. Both of those would be the highest readings since October 2023. Here would be your supportive fodder for a rate hike at face value. But of course, what we see here is that food is overwhelmingly the driving force here. So inflation is being taken to these heights largely thanks to the cost of imported food. In fact, if we take a look at the makeup of Japanese inflation here over the course of November, that gave us a 2.9% headline rate, already quite high relative to history. Of that 2.9%, 1.38 percentage points was the price of food. Moreover, 0.47 percentage points, so almost half of a percent, was energy. So much of this seems to be the cost of imported necessities and the generally weaker yen. Now, if we consider these dynamics, we can see that Japanese CPI tends to respond to changes in the price of, in this case, we're looking at crude oil as a kind of stand-in for energy, and we're looking at the Brent benchmark, the global cost of oil, not the U.S. benchmark, which tends to run a little bit cheaper, as well as the FAO food price index. This is a global index from the World Bank here and the IMF. So what we're watching here, and to be very clear, they produce this data for the most part for the UN. We are looking at the pass-through, and very clearly here we can see there is, when you lag CPI 7 months or so, it doesn't line up perfectly, of course, but very closely, you can see how long it takes for these things to work their way into prices. And although food has been ticking higher, and perhaps there's room for that to continue here, energy has been going the other way. And so perhaps the BOJ has some room here to wait until we get to March with the wage setting period upon us. The governor, Kazuo Ueda, has mentioned that he wants to see how wage negotiations go, to see how embedded inflation is going to be before acting. If there's a miss there, that could certainly be a shocker for the yen if the BOJ opts against a move this time around. Then finally, toward the end of the week, we are going to get the flash PMI data giving us an update on global growth trends from the major economies. And of course, the big story here is another contraction from the Eurozone. 50 is neutral in the logic of these numbers. Above 50 is growth. Below 50 is contraction. We can see the Eurozone here slated to register below 50 yet again for a third consecutive month, whereas for the U.S., the story is of ongoing outperformance. In fact, the pace of growth expected to pick up a little bit as we get slightly faster growth from the service sector. Looking at surprise index data from Citigroup, we can see that there's been a sort of divergence here where U.S. economic data is once again increasingly surprising on the upside, Eurozone data is increasingly surprising on the downside. And so the surprise here may well be a wider disparity in favor of the U.S. But of course, that would again mean less scope for Fed rate cuts and a greater threat to global growth, which we can see here is idling in recent months, even as the U.S. outperforms because everywhere else is so weak. So perhaps a bit of scope for sobering event risk toward the end of the week, threatening to revive worries about the dissolution of Fed rate cuts, threatening to revive yields, and warning stock markets. And that is macro money for today. As ever, we will get back to all of these things in greater detail as the week progresses. We're here every day, Monday through Thursday, right after overtime, a show that I co-host with Dylan Radican and Chris Vecchio, looking at the Wall Street close and what may follow. In just 30 minutes from now, I'll be on with Victor Jones for The Price of Truth, back with Chris for Futures Power Hour on Friday, and with Victor and Tom for First Call on Sundays. I'm also writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and Blue Sky. Thanks very much for watching. Macro Money's back tomorrow.